Welcome to the Your Money Personal Finance Podcast. I'm Peter Cishecki, president of Everything Financial Group. Today, we're going to continue on our journey, making our way through the Omni formula from beginning to end, how we do a financial plan. Today's topic, Critical Illness 101. Hopefully, we're going to make it simple for you guys to understand, because I know insurance is a bit dicey sometimes and a bit boring, but we're going to spice it up a bit. Today, we have a guest in studio with us, Chris Cook. He's this, I got to get this right too, it's a long title. Senior Sales Consultant, Life and Living Benefits of RBC Insurance. He's going to answer the key questions about critical illness, as always, that you didn't even know you're supposed to ask. And we're going to hopefully help make some sense of it. Now, Chris, welcome. But full disclaimer here, because you guys know how bad I am and how much I can't stand the banks and RBC. RBC Insurance, though, is the black sheep of the family of the RBC Bank. You don't have to worry. If we recommend an RBC product in the Omni formula with your financial plan, you're not going to get those tellers. Remember, they're not listeners, they're tellers. They're not going to be calling you, trying to get your business, because RBC Insurance really has nothing to do with the rest of RBC. Would that be fair?
Yeah, that's fair. The Bank Act essentially separates us from the bank, where we can't share information. So peace of mind for you there.
And going back, I mean, this takes us way back, but I mean, I've done a lot of business with different critical illness companies. Granted, we don't do one. We look for the best one for the clients. But RBC on the disability, which we're going to be talking about in our next episode, and critical illness, I mean, is really there because they purchased years ago probably the best North American living benefits company.
Yeah.
I mean, when they created RBC.
Yeah. Our RBC Insurance's history is really founded on acquisitions, and it was acquiring disability specialist carriers. So you look at some of these that were in Canada for a while, Unum, Paul Revere.
I was going to say Paul Revere, we can go way back now. We're
really dating ourselves. So these carriers were bought by RBC, and that's kind of how RBC came to be as a larger insurance company.
Yeah, and they do have a great product, or else I obviously wouldn't have you here if I didn't believe in it, but they're really good. But like we said before, bring in the experts. So let's dive into this. Really, to get us going here, as basic or as detailed as you want, kind of give our viewers and listeners a good overview of really what is critical illness insurance.
Yeah, well, critical illness insurance, and it's really a financial planning tool. So I think with any form of insurance, what you're doing is you're basically making a trade. You're trading money, your own money, to protect you against a risk that might or might not happen. And if it does happen, you don't know when it will. So with critical illness, what you're doing is, well, you're paying a premium or a monthly or annual payment. And what you get in return is, if you get diagnosed with one of a number of conditions, and pretty serious ones. So with critical illness, we're looking at things like cancer, heart attack, or stroke. You're going to get a lump sum of cash from an insurance company. And that's cash that's yours to do with as you will. There's no conditions on it. You get that payment into your bank account. You can use that for whatever you need to use it for. That's, in a nutshell, critical illness insurance.
So lump sum of money, but I know with critical illness, and you actually said the heart attacks, cancer, and stroke, or as we refer to them as the big three.
The big three.
So those are the ones, correct me if I'm not, that are covered in because there's different tiers, different levels of critical illness. It's kind of like buying anything else out there. You can buy the basic stripped down version.
Yeah.
Or you can buy kind of the loaded version.
Yeah.
So the difference is really between basic, if you will, critical illness insurance, or enhanced or loaded up critical illness insurance. What's the difference in those two?
Yeah, so a subtle difference between the two. So when you look at basic, you're covering off those major illnesses, the big three: cancer, heart attack, stroke. Oftentimes, you'll also have coronary artery bypass surgery in there. So you could count almost 4. So when you look at these account, heart attack, cancer, and stroke account for about 85% of all critical illness claims. So even with basic, you're covering a good range of risk right there. You're covering the biggest sources of major illness, life-changing illness. The enhanced version, though, gives you some added protection. Now you get into other illnesses that are equally as life-changing, things like Alzheimer's or MS or Parkinson's, something that is going to affect you and probably your family for possibly the rest of your life. And so if it does, how much of a difference would that lump sum of cash make for you and for maybe your recovery journey, or maybe just your long-term financial outlook when you're hit with this major illness? So both very good plans, but the enhanced gives you a little added protection in that it's covering more risk, if you will.
So the enhanced is a Bentley and the basic is a 74 Pinto.
It's a good way to look at it. Yeah.
Don't even ask me my stories about the 74 Pinto.
Yeah.
There is stories about that from my youth. So how often do you see, and I know how often I've seen in 30-something years of doing this job, and not that critical illness has been out that long, but since it started, but how often do you see claims of critical illness insurance? I mean, because it's like life insurance is kind of, which we talked about in an earlier episode, is kind of there. It's life insurance. You die, you get a claim.
Yeah.
Or your family gets a claim and they think, but critical illness, and we'll talk about this a bit more, is kind of like that disability type insurance benefit. So are claims easy, and do you see them often?
We do. And yeah, I think what you mentioned there about it being something that's living, it's a living benefit. Mm-hmm. So the person that's claiming on it is usually the person that's bought it. So they remember going through that underwriting process. And so we're starting to see a lot of claims, and we always have. It's when you look at cancer, heart attack, or stroke, many of us can think of a family member, a relative, a friend who's gone through something like that. And if they are, that's where the insurance really is invaluable, because now you're getting a cash payment that you can use for whatever you want. And the claims process is something else entirely. And what we try to do as an insurance company, every insurance company does, is you get a claims examiner who's going to be your person, who's going to look at your medical file and figure out whether you have one of these critical illnesses. And there's a line there as far as what we define as a critical illness. So even something like cancer, which we could get into, is it a serious cancer, or is it something that's maybe detected early on that's not necessarily
I was just going to ask you, because some cancers don't count.
Yeah.
Sorry, guys. Not really say don't count, because God forbid you have one. But there is certain diagnoses that are not considered critical illness, even though it's cancer.
Yeah. So that's where it's important to understand the contract and what you're getting from an insurance company, any insurance company, because they define this. So what's nice with a critical illness insurance contract is that they very clearly define, what's a claimable cancer versus one that, maybe isn't serious enough for you to get your full benefits. So an example would be, we're two guys, prostate cancer. Mm-hmm. So you look at prostate cancer. If you've got stage T1A or 1B of prostate cancer, that's not critically ill enough to get a full payment on a critical illness policy, if you can believe it. That being said, it's when prostate cancer is detected very, very early on, it's fully treatable. So what an insurance company does is they actually pay out an early detection benefit or an early assistance benefit. So they're basically saying, your illness, your prostate cancer is not serious enough that we're going to pay you the full amount that you bought, but we're going to pay you 10% of what you bought. So if you had a $100,000 critical illness policy, you add stage T1A of prostate cancer, you'll get a check for $10,000.
If you have this early detection prostate cancer, you've collected the $10,000, but now your prostate cancer, unfortunately, like I said, God forbid, advances beyond that and becomes more serious.
Yeah.
Can you still claim the balance?
Sure can. You can claim again. So with some carriers, you get the balance. So let's use the example of $100,000.
Sure.
So you get $10,000 check initially for the early detection. Now your prostate cancer progresses to a point where it qualifies as a critically ill cancer. And at that point, you get a check for $90,000. So you can definitely claim again. With some carriers, and RBC Insurance would be one of those, the early detection benefit doesn't erode your $100,000, your initial amount. So believe it or not, you could get a payment of $110,000 over time.
So it's not just the balance.
It's not just the balance. So you get the full payment. So you get the early assistance benefit of $10,000. The $100,000 stays as it is. And if you end up getting a more serious cancer, whether it's prostate cancer or you're just unlucky and you get another form of cancer or heart attack or stroke or any of these other conditions, if you have that enhanced plan, you get a check for $100,000.
Well, it answered one of my questions I had later, and you didn't even know it, but I was going to say, can you collect more than once? The answer is yes. But let's expand on that a little bit. if you got a cancer, so with prostate cancer, and you collected your $100,000 in this example, you recover, it's great, life goes on, 3, 4, 5 years pass, you're still paying your premiums, but you get another form of cancer, because it's not like you can get prostate cancer twice if it's removed. So you get another form of cancer, you're still covered then. You're still able to claim.
So if you get that early detection payment, your policy's still in force. It doesn't go away.
What if you get the full, what if you never got the early detection? What if you had, let's go with lung cancer.
Yeah.
Something obviously more serious, but you're fortunate enough you get through it, and they've paid you out your $100,000 for lung cancer diagnosis or a heart attack.
Yeah.
Are you done with the policy at that point?
You're done with the policy at that point.
So once you have one full claim, if you will, major claim, whatever, non-early detection claim, let's say, the policy's a one-time payout. The only time there's a multiple payout is if it's an early detection payout and then a full-fledged payout later on.
Yeah, it's a one-time shot.
But you could you not buy another policy? But there would be obviously something you've already been paid out for would be excluded, but
you totally could.
You know, maybe you're worried about, maybe you had the heart attack and you're still worried about stroke, MS, Lou Gehrig's, like who knows, or ALS, but you know, I mean, okay.
Yeah.
So you mentioned about early detection. So what other, not that that's an add-on benefit, that's just obviously part of a definition that's inside RBC and some other companies' plans, but what are some other benefits? Because I know you can do, not that I'm a fan of it, but because I'm not, but return of premium, pay more, don't get a claim, get your money back. But what are some other benefits you can get added onto the plan? Because even going from the basic to the enhanced is like a additional benefit.
Yeah.
A different choice.
Yeah, it's definitely a different choice and a different benefit. And there are other things you can do to the plan, other benefits you can add on. Return of premium, you mentioned one. There's also one which is called a waiver of premium upon disability. So again, looking at this as a living benefit along with disability insurance, it's meant to be something that's going to cover you while you're alive. What if you suffer an injury, you're disabled, you're not working? It's not a critical illness though. So you still have that risk that you want to cover. You can get this feature added to your policy when you buy it that waives your premium if you're disabled. So basically saying, you know, I'm sick, I can't do my job, I have no income coming in, I can't afford the insurance premium anymore. Well, this rider is going to kick in and say, well, don't worry about it. We're waiving that premium. So if you again are one of those just incredibly unfortunate people, you're disabled, and lo and behold, here comes a critical illness, a heart attack or cancer that comes along, your policy is still in force. You can still claim on it. So that's a nice feature. There's another one with RBC Insurance, which is called a scheduled increase benefit rider. So what that does is it's kind of a financial planning tool where you can buy an initial amount of critical illness insurance today, perhaps what you can afford on your budget today. And over the next 10 years, every 2 years, it gives you the ability to increase that coverage by 10%. So you could start at $50,000. Over time, you might get up to $100,000. And that happens every couple years. So now you're kind of, maybe it's a plan that you're buying today that you can afford today with the hope that over time, maybe as income changes or expenses change, now you've got more money to put towards the premium. As your coverage grows, you eventually get to that $100,000.
Well, that actually ties into how we at Everything Financial with the Omni formula explain critical illness insurance. I know there's brokers and those people I like to slam out there, the insurance salespeople who are just trying to like buy my insurance policy because that's the only thing you need for a financial plan. No different than a mutual fund salesperson going, oh no, this is your financial plan. You bought RSPs, and they try and convince you that's your plan. But when we do the Omni formula, well, there's kind of 4 pillars in planning. You've got, well, God forbid you die. There's life insurance there to look after your family. Doesn't really help you, but it does help them. But if nothing happens to you, then you have your retirement planning, pension, investments, etc. And then there's obviously the number 3, which we're going to talk about next episode, is disability. Can't work. Your biggest asset, really, your health and your ability to earn an income. And we'll talk more about disability, how it doesn't really pay you enough, but it keeps you going, and it's not quite replacing all your income.
Yeah.
But the problem is, as we'll get into more later, disability, you have no more money to pay, put money into retirement. Pension contributions from your employer will stop, or RSP contributions, et cetera. So that's where we look at everything financial, is critical illness as the financial planning tool. If you can no longer, you said income stopped, you can no longer save money. Maybe there's some bills you were paying down before that now you can't pay down.
Yeah.
There's where looking at critical illness. And I know a lot of salespeople use that guilt factor. Oh, you can go to the front of the line, go to the Mayo Clinic, go to this, go to that. Well, it's a little fear factor selling, because in Canada, 99% of the time, you're going to be able to get in for a treatment most times. Yeah, there is always cases where, my spouse didn't make it. They had a heart attack waiting for a treatment. And those things happen. It's horrible. But I work in the States too. And guess what? Those things happen there too. I mean, so we look at the critical illness as, what lump sum of money do you need to fill in the blanks in your plan, right? Like you just explained. And this idea of this added benefit where it grows is great, because when you're doing a plan, you're trying to buy coverage or do investments in all four of those areas. But I think this feature is huge, because maybe you can't get the right amount of disability insurance yet because you can't afford to cover all your income.
Yeah.
You can't get the right amount of life insurance because you're in your 30s or 40s with a new family. Better off to cover a little bit of everything. So yeah, this benefit would be huge. Oh, I need $200,000 of critical illness insurance. I've priced it as cheap as I can. I can still only get 50, 60, or 75,000.
Yeah.
But my kids are 3 years old.
Yeah.
And I still have I was going to say you still have a $500,000 mortgage, but in Vancouver, that's just the doghouse outside. Yeah. And it's not much else. But
no.
Yeah, that's a great benefit. So when you're doing the critical illness insurance and you're applying for it, and we know I've been doing this for a lot of years, and we know how long those questionnaires are for insurance. Yes. But what kind of family history is looked at in doing an application for critical illness? Like, how can that affect your ability to be approved or the cost of the critical illness insurance?
Yeah, family history matters. I'd say family history matters more so for critical illness than possibly any other insurance product, because you look at the types of illnesses that can be hereditary. So a number of cancers where, if there's a history of it in your family, well, then there's a greater likelihood that you might get it. You might not. But again, that's the risk, the trade-off we have with insurance. You might get it. And if you have a family history of, say, breast cancer, well, then you might be a little bit more likely to get it than, say, the general population. And when you look at insurance companies, they're looking at kind of general population stats, and they're trying to kind of price a product based on that. So when you look at family history, things that insurance company is going to look at, number one, well, family history. But not only that, but age of onset. So was it early onset? Was it a parent who maybe was diagnosed with a form of cancer in their 30s or 40s, something that's hereditary? That makes a difference. It's the age of the client when they're applying. Is it a client that's in their 20s or 30s? Well, they still have a lot of years left and a lot more risk to an insurance company. Other items that might make a difference is, the number of individuals in the family that have suffered from this illness. So is it something that maybe only one parent has suffered from, or is it maybe a great-grandparents and something that can be traced back further? So an insurance company is going to look at all these, and in an extreme, there could be a scenario where they say, look, we can't give you a standard price. We're going to rate this because of your family history. So if we're worried enough, we might say, well, you're going to have to pay a little bit more than the average person. So a rating is often a percentage where they'll say 150%, which means you're paying, 1.5 times more than what that market price is, or 200%. So that's something an insurance company does to kind of plan around their risk. At the end of the day, insurance companies are there to make a profit for their owners, shareholders, whatever.
Well, profit's bad, didn't you hear?
Yeah. So they plan around that. They try to manage that risk, knowing that you might not ever get it, but there's a greater likelihood that you will than the general population. So because of that, they charge you a little bit more.
Now, is there a point where I mentioned earlier, and you kind of alluded to it there about exclusions or ratings, but where say they would exclude one of those 20 something, 25 or something, or 27, whatever is enhanced benefits. Is there a point where they go, okay, we've excluded this, this, and this, and they'll just go, okay, we won't cover you anymore, and we'll just decline the application?
Yeah.
I imagine it hits a point where you go like, how many things are you going to exclude? Oh, you're buying a 25 enhanced policy, but we'll only approve you for one.
Yeah. You get to that point. So yeah, an insurance company, definitely, they'll look at it and say, well, let's say the early onset breast cancer, family history of it. So they're going to exclude breast cancer, but maybe there's other things going on with you where now they say, well, now we need to exclude these other 6 conditions. And we also have to rate you 250%. Well, it gets to the point where there's so little value in the plan that they're just going to decline and say it's just not worth the bother. So that's a very real risk. So you can, as a consumer, be declined by an insurance company if your family history, if your own personal health is bad enough that they're concerned. So,
well, it goes without saying, get it early while you're healthy. That's the thing, and people don't understand that. We try to explain it a lot of time. They go, well, what if I get this later? They're gonna, because everyone's got the evil insurance company. But I've been doing this 30-something years, and it's real simple. Tell the truth on an application form, and if they approve you, that's the picture of your history is right then, not what happens to you 6 months, 3 months. I mean, I had a client, I mentioned to you earlier before we started recording, who paid one premium, got diagnosed with stage 4 cancer, and collected on an insurance, and it was legitimate because she didn't know she had it at the time. There was no doctor record. She'd never been, for this thing, and it's nothing that was picked up in when she did the application. It occurred after, and they will pay. I mean, it's that simple. Tell the truth. There's no fraud. You're gonna unfortunately get your claim paid. I mean, but that's what it's there for.
Yeah.
So with this type of insurance, I know with life insurance, we talk about it a lot as a key financial planning tool, and the benefit is tax-free. So we talk about disability, which we'll talk about next episode. There's 2 different versions, taxable and tax-free. So how is critical illness? How is that claim viewed by the CRA?
Tax-free for the most part. It's whether it's a tax-free payment to you personally because you're the insured, you're the owner of your policy, or in corporate settings, you might have a company, maybe it's your own company, that buys that critical illness insurance for you as a key person, or maybe it's a form of shareholder protection or buyout. In that case, it's tax-free to the company, and the company can then use that cash for whatever they see fit. So quite simply, critical illness tax-free, and it's paid for with after-tax dollars, whether it's after-tax personal dollars or after-tax corporate dollars.
So it's like the living life insurance benefit, but it's also like the lump sum disability benefit.
Yeah,
it's got a great purpose, and it fills a lot of holes in a financial plan.
It strikes a nice balance. And one thing I like about critical illness insurance too is that even if you have an RSP account that's well invested and well funded, you have a tax-free savings account, even if you're financially independent to the point where, if an illness strikes, it's not going to leave you financially, destitute. Even in a scenario like that, critical illness has a place, because when you look at what it does, it eliminates the timing risk, market timing risk. So look at what we're in today. If you were to be diagnosed with an illness and you had a non-registered account you could pull money from, maybe it means getting treatment in the States, or maybe it means you need to take time off of work. Well,
you got to enhance your house and put in a wheelchair
enhance
ramp,
your house.
And who knows what else?
Whatever the case may be, any sort of expense, what do you want to do? Do you want to pull from your investment that's just lost 20%? Or do you want to get a check from an insurance company, leave your investment as it is, and hope that maybe it's going to bounce back over the next few years? In a perfect world, if you're in your 30s, 40s, you're still growing your investments and your career, maybe you're investing in higher growth stocks, funds, whatever the case may be. And as you approach retirement, you start to take away some of that risk. So maybe you transfer that to fixed income, so that you're not at mercy of sort of the volatility of the market. Well, the thing with cancer, heart attack, stroke, they don't care. They don't necessarily give you advance warning on when it's going to happen. So, you might have
They don't discriminate against age, race, or economic
None at all.
So it doesn't matter.
You're never ready for it. And you're probably never financially ready for it because you haven't really rebalanced your portfolio to address for any volatility or market risk. So if you get that illness when you're in your 40s and you're still heavily invested in growth funds or equities and you see an investment portfolio that's gone down, the great thing with critical illness is you don't have to touch it because you've got an insurance company that's cutting a check for you. You can use the insurance company's money for whatever it is you need to do.
And we explain that to people too all the time in our planning, that one of the biggest risks to your health or the biggest stresses is financial.
Yeah.
Like it's one of the biggest stresses on a marriage too, financial instability and financial stresses. And if you get diagnosed, the best thing you can do, it's bizarre, but is have money to put that stuff on the back burner and focus on yourself, your family, and your health.
Yeah.
I mean, and this is just one of those areas. And it's one of those things we've been doing it a long time. But when we mention it to people, they kind of go, as part of a plan, we kind of get the, huh?
Yeah.
What's that? Because everyone goes life insurance and the automatic reaction is, how much is it going to cost? Or do I need it? Or how much do I need? And then, we talk about disability, because I think disability, which we're going to talk about next episode, in episode 12, but is the most important insurance because it affects everybody.
Yeah.
But as we said, you've hit this one really good, is where the gaps are. And people just don't see, no more pension money, no more RSP money. And as you said, if you're in your 30s or 40s, you've got 20, 25 years of savings for retirement. You probably don't have that much put away yet.
No.
And all of a sudden, a lump sum of $100,000 or $250,000, maybe you've got great disability at work or personally, you're fine financially. But what if this illness, whatever it is, lasts the next 5 years? Because it can take a long time to recover from some of these things.
Oh, yes.
And again, if financially you're set for the next 5 years, that's a good thing. And tax-free. And I love tax-free because anytime you can stick it to CRA, you win. That's a good thing. So folks, that pretty well does it. We want to thank Chris Cook from RBC for enlightening us, educating us on critical illness insurance. He will be back though, because he did so well. We're going to bring him back for an encore in episode 12, where we're going to talk about disability insurance, as I say, the most important insurance you could ever own, really. But in the meantime, if you want to get in touch with us at Everything Financial, you can go to YouTube, look up the Everything Financial Group channel, look at all our different podcasts, go to everythingfinancial.com or email us at yourmoney@everythingfinancial.com, and we'll see you in episode 12.